Hey guys, so February dividends. Um, we've all had a volatile February, and I have a feeling we are going to have a volatile March. But one thing that you can be assured of for the most part, and I do say for the most part because somebody like me who likes to mess around in the high yield investing world sometimes gets burned. But that's okay because luckily, uh, I didn't panic. That's a good thing. I was a net buyer throughout February. Made a couple of, ended up stuck in a couple of stocks, and I'll talk about that here in a little bit. Sold out of some stuff, but nothing during the correction, so that was good. And overall, things are fine. So we'll just go over the additions, or some of the additions I made to the portfolio. I actually made quite a bit of changes in the portfolio. M1, I don't know if I talked about this. I guess I should have checked, but I added, if you guys don't know, okay, the dark blue is the M1 finance account. The bright green is the Fidelity, my wife's Fidelity Roth IRA. This dark green is something new. This is a Fidelity taxable account that I'll discuss about what I got in there and why. And the lighter blue is the Chase Roth IRA, aka my high yield Roth. So let's go in. I really didn't do a whole bunch of additions into M1. Added a little bit of money here and there, 20 bucks here, 30 bucks there. But I actually did add about 150. I'll take that back when I added Pepsi and Prudential. I added Pepsi in because Pepsi just, even though they missed earnings, they still didn't go down. It really just does not. It refuses to succumb to any kind of pressures. I mean, it's down now. I think the 52-week high there was 147, and it's now 137. You just buy it. It's Pepsi. And then Prudential, I thought was given a very good yield at 4.5. I think when I bought it, or a little over that, and now it's over 5.5. So I think Prudential still, and I'm, was underweight financials. So I just wanted to add that in there. And it's still up in the air whether I keep M1. I might. I just have to figure out why I have M1 Finance, and that's you know kind of hard to say, to be honest with you. So going to my wife's Roth, I sold out of BTI, British American Tobacco. I sold 15 shares. I was up about 20+% in that. And the reason why I sold is because I also have MO in my high yield Roth, and that was up, 13. It's now 13. I think it was higher than 13% of the portfolio. And I just figured I didn't need two tobacco stocks. So I sold out of BTI, and I kind of spread that around a little bit. Actually, quite a bit. I bought some Pfizer. I don't think Pfizer was in there last year. I got 28.5 shares of Pfizer now. No, I think there was in there. I could be wrong. I should have been more prepared. But I added Apple Hospitality, which is a hotel lodging REIT, which has been under pressure. And I got in pretty much at the 52-week low, close to it. Around 13 bucks is where I got in, because I averaged down a little bit. I started off with 10, bought another 10, bought another 5, something like that. Ryder Systems is another beat down stock, and this one might have been a mistake. I don't know. I like the trucking industry, and I think that's how I decided to get in there. Plus, I was underweight industrials. I only picked up a few shares. I got 7 shares there. It's yielding about 6%. They declared their dividend at 56 cents. It's a tough one. I do like their future. They are partnering with a bunch of, well, not a bunch, but with some companies looking forward to the electric vehicle market or electric semi trucks. So they're involved in the infrastructure of getting charging stations around, truck stops and whatnot. Wells Fargo, I added some shares, and then PPL, which I've always needed a utility. I bought that, and most of these buys I bought before the correction, so I'm down quite a bit on PPL and actually everything. But I'm very happy with my wife's Roth, and I'm just planning on keeping adding to. I'll probably keep adding to Pfizer for sure. I'd like to build up Apple Hospitality, and then Wells Fargo and PPL. Those 4, I just want to keep adding to those here. And Ventas, man, they're giving you another opportunity to get in. I'm in at about 50. I think my average price is 56 or something like that, and they're selling now for 52. I may go overweight and get into them. They're offering a 6% dividend yield. I think it's an excellent opportunity right now. Now the new account is a Fidelity taxable account, and I put in there a closed-end fund. And if you don't know what a closed-end fund, please watch my video on closed-end funds. I did a basic overview of closed-end funds. There's a lot of intricacies that I did not go over that you need to understand, and I probably don't have enough time to go into it right here. But this closed-end fund I recommend in a taxable account only, and that is because part of THW's distribution right now includes return of capital. And I'm not gonna, I need to do a whole video on return of capital. What return of capital is return of your own money. That's not necessarily a bad thing in an actively managed closed-end fund. They may need to return your money because they're holding on to an investment that they don't want to sell just to pay your distribution. So, and also what return of capital does is also lower your cost basis. So as that distribution comes back to you, your cost basis actually goes down. Closed-end funds aren't for everybody, guys. Just because you see a high yield in a closed-end fund, please understand how closed-end funds work before you invest in them. I really debated whether I was going to actually share this in this video, but I figured, I'm not going to hide anything. So, and let's see. Oh, in my high-yield Roth account, I had quite a major change. Not major, but I had Geo Group. I sold covered calls, and 100 of my shares got called away from me. So that gave me about $1,700 to spread around, and I spread it around quite a bit. I picked up MDP, Meredith Corporation. They have been paying dividends for about 27 years, growing dividends, and they have a very low payout ratio, but they have a lot of debt. They're yielding about 9.3% right now. And I think they'll be doing the news is they hired the old GE CFO, I think, and I don't think the investors like that, and I'm actually kind of questioning it myself. I picked up OZK, which is a bank, and they're paying almost a 4% dividend yield, and they are also I don't know if they're over 25 years yet as an aristocrat. They might be, but they are definitely a dividend grower for sure. what else did I do? I rounded out Ford. No, I didn't have Ford last time, so I picked up like 85 shares in the middle of February, dipped a little bit, and I rounded it up to 100. I added 50 shares at the exact wrong time into Vermilion Energy. They are now yielding 19.5%. They have declared already their dividends. So I'm watching the oil price very, very, very closely. It had a big spike today, so that was very welcome. Tanger, I think, paid out a dividend, so I got me a few more shares of Tanger there. They're now paying 11.6% dividend yield. I think they're a buy. I don't care what people say. I'm a mall bull. And then two new additions, AMC Theaters. Now, I kind of got stuck with these AMC Theaters and Washington Prime Group. A lot of y'all gonna laugh, but in 2019, I flipped WPG for a pretty quick profit, and I thought I'd go to the well and try again. And AMC in February, I flipped for a 7% profit pretty quickly, like right here. I did 100 shares, acquired on February 3rd, sold on February 14th. It actually got called away because I bought 100 shares at $6.56 and I immediately sold a covered call at $7 and made like $7 on that call. So I made a total of $51.28 or 7.82% on that trade. And I went back to the well to try again, and yeah. I think both of these, because both of these had earnings, AMC and WPG, and I think if we didn't have this week or 10 days of correction and we were in normal market, situations, I think I could have I'm pretty positive I could have flipped these because, but they were both expected to cut their dividend, and I knew they were going to, and they both did. They didn't eliminate them. AMC went down to, they were at a 10% yield, and they are now down to a 2% yield. And Washington Prime Group was at a 40% yield, and now they're at a 20% yield. So they cut their dividend in half. But I listened to the Washington Prime Group conference call, and I'm actually convinced they have a lot more room if we can get over this illness thing. I don't want to say it because I don't know, apparently YouTube doesn't like it, but they freed up a lot of money to do some redevelopments in WPG, and I might be a net buyer of both AMC and WPG. There still might be some pain ahead, but I'm a bull on AMC. Everybody says the movie theater is dead, but if you look at the past 10 years, attendance has been flat. So, flat doesn't mean it's dying. Flat just means it's not growing. And I think if we can get over this little illness thing, I shouldn't call it little, I'm not downplaying it, that both of these could be a good trade. So those were a lot of changes there because I added Ford, I added Meredith, I added Bank of Ozark, AMC, Washington Prime Group, reduced my exposure to Geo, almost got out of Nokia, but and then I did this quick trade on AMC and made some money. I started selling covered calls. Right here, covered calls, I made $73.70 for the month of February. If you annualize that, that's huge compared to what my monthly my yearly dividend income is. That is huge. But covered calls really work best in flatter up markets. Since we're in a downtrend, I don't see March being very well to me on covered calls. But nevertheless, $73.70 went into, other stocks that are paying dividends. So net, that's a positive. Wealthfront interest. Shoot, I put that in there. This is actually March. Wait, shoot, how did I do this? I had January. Oh, you know what? I think this was December's payment. This was February's payment. Or this was January's payment. This is February's payment. So I think I have December's in there. Oh, well. So what does that do for me as far as allocation? If you look at my old allocation here versus my new, this is my old. I know it's hard to see, but I had 48% in real estate. I got that down to 35.2. Hardly had any financials, had 0.9%. I got that up to 4.5. Consumer staples actually went down from 18 to 13.9. That was for getting rid of British American Tobacco. I increased energy from 9.8% to 11 at the wrong time. Healthcare went from 6.5% to 7.5. Industrials went from 1.3 to 3.7. Technology went from 3.3 to 3.7. Consumer cyclical. Oh, I didn't have any consumer cyclical, so now I got 3.8%. I think I added that. Oh no, I put AMC under communications. So communications, I had 11.1%. Now I have 16.3%. And then I didn't have any utilities, and now I have 1.1% utilities. So I'm balancing out this pie quite a bit. That's a big difference between January and February. And I'll be adjusting that. I don't know if real estate might start creeping back up if I start seeing these deals coming around, but I know this is going along a long way. But basically my annual income has become $1,525.64 with a monthly average of $127.14. So I am 63.5% to my goal of $200 a month average for 2020. So last month ending January, my portfolio was yielding $1,444.30, and ending February we are at $1,525.64 for an increase of $81.34. That is a 5.63% increase in dividend income, annual dividend income. So overall, if I were to buy all my stocks right now, they would yield me 7.28%. I got rid of my yield on cost. There's a lot of columns that I had that were just real messy to me, and I just wanted to keep it simple. So there you have it. That's my February portfolio update and income update mainly. If you have any questions for me, any thoughts, please leave them down below. If you followed this long, I'd appreciate it if you thumbs up, give me a like and a comment. Comments are definitely appreciated. And yeah, hope you enjoyed. We'll talk to you later. Thanks. Bye-bye.